Hello and welcome. I'm Chinmay Kulkarni, the founder and CIO of Cambridge Wealth. And usually we don't do a lot of these weekend specials, but I think today is a special day. Sheetal joins us, and I'm very excited about this because Sheetal has more than 2 decades of experience with capital markets, and she's worked with a lot of global banks like Credit Suisse and Barclays, where she currently is a director, and also JP Morgan. So welcome, Sheetal. Thank you so much for joining us. We've been working together for the last about 4 or 5 years, and I've been thankful to be a part of your investment journey. But what we'd really like to know, Sheetal, is how, if you can tell us a little bit about your overall journey in terms of your banking and capital markets journey, and then also a little bit personally as an investor, and when did you start and how did you start?
Sure, absolutely. So firstly, thank you for having me. Very excited to do this, even though it's a weekend, but having a chat with you is always fun. Um, so I have about 19 years of experience, primarily in technology, though I have worked primarily for investment banking throughout all of these 19 years. I have worked for banks like Morgan Stanley, JP Morgan, Credit Suisse, and now I'm a part of Barclays. Um, I I have an engineering background, but got campus placed in Morgan Stanley. And I'm a very passionate technologist. I enjoy working in technology. But at the same time, I think I enjoy finance and banking as well and learning more about it. So I think it sort of completely fits into what I've wanted to always do in my life. So my journey for the last 19 years has been very enjoyable. So I started working when I was 21. And those days when I got placed in Morgan Stanley, I actually made a decent salary. But I come from a background where my dad also has a lot of banking experience, and we were always taught that, there's a certain amount that has to go into savings. So naturally, even though I was, very young, I started sort of putting some money aside every month at that age in 21.
Wow, we
But
started
I think
early.
it was early, but it was traditional, right? So I started a recurring account,
Okay.
and I started then sort of investing in fixed deposits, So that is all that I did. I didn't understand anything more than that. And to be honest, neither did my family want me to do anything more than that, right? So I think that's where my journey started. However, over the years, I've worked and, invested with different wealth managers. But I never had really the time, energy, or to really put my head to it. And so I've always wanted to work or always wanted to invest with someone who I completely and blindly trust. So I think that's what I have always looked for, when I've, looked for a wealth manager who could help me with my investments.
Right. So, a couple of very interesting points there, Sheetal. So, number one, I think most of us who come from families that have earned wealth and not inherited wealth,
Yes.
we tend to be very cautious with
Yes.
money. And, another thing that we speak of very early, and we had discussed this, I remember when we started, is the difference between savings and investments.
Yeah.
And they both look exactly the same on day one.
Yes.
And they have dramatically different outcomes,
Yes.
as you've
Yes.
experienced now.
Yes, absolutely.
Right? So that's an interesting point, that you started with savings, and then somewhere
Yes.
along the line, and we'll dive in slightly deeper, into it in the next piece. But somewhere along the line, you switched to investing.
Yes, I did.
And how
I
have
did.
the difference between those
Yes.
two kind of journeys is interesting. But the other piece is very interesting, Sheetal, that you did one thing that is extremely rare, which is start early.
Yes.
Right? Most of us wait until we are in our 30s or late 20s to actually start meaningfully investing.
Yes.
And not by investing, I don't mean speculating.
Yes.
Right? So, for example, I'm not talking about an online trading account where you kind of do a daily transaction or a daily trade.
Yeah.
I'm talking about more like long-term investing, goal-based stuff.
Right.
So could you tell us a little bit about what prompted you? Because at that age, look, you can party it away, you
Yes.
can buy something, you
Yes.
can go on a holiday, or
Right.
you could invest.
Yes.
And there's no immediate payoff in
Yes.
investing.
Yeah.
So what
So
prompted
I
you
think
to
I
do
would
this
give
early?
complete credit to my parents. And I've always been a very hardworking child since a kid, and I think I worked very hard. Even those days, right out of college, I started working. It was it was an aggressive bank at that point. Technology was booming, so there was just so much happening, and I was working really long hours and working very hard. So I didn't want to sort of blow off that. I didn't have an attitude to work hard and party hard. So I had an attitude where I did work very hard,
Whether,
and I wanted to ensure that, I'm sort of
make it count.
making it count. Yes.
Yeah.
So that was, and I think complete credit to my parents. That's how we've been raised.
Oh, that's a very, very interesting ethos, and I think that'll. I'm sure it'll kind of help our viewers because, and I think we've often discussed that's an ethos we share as well.
Yes.
That. So I love something that Shah Rukh Khan once said, which is, work hard until you're successful,
Yes.
and then work harder.
Yes.
So he says many people have actually worked harder than me to get successful.
Yes.
But after you're successful, he
Yes.
said, I've worked the hardest.
Yes.
And I love that,
Yes.
because there is no question of resting on your laurels or,
Yes. Yes.
relax, you kind
And
of
that's
made
a
it.
common thing between us as well. I think someone, maybe now that I'm a director in a bank, I manage a large team, I would have been like, let me just take it easy. But it's never the case. Like every day, you're looking for, and you're actually hunting for a challenge. It's
Correct,
like,
correct,
you want to
correct,
do more.
correct.
So I think that hunger has never gone away.
Correct. Once you kind of get used to that
Yes.
ethos, it's just more and more fun to do
Yes.
newer challenges.
Yes. Yes.
So lovely. And the reason I stress on this also, Sheetal, is because it's a very, very important aspect of an investor's journey, because it's not just about the returns, right? It's the biggest points of, investment success is about time,
Yes.
and B, about consistency of allocation,
Yes.
right? Over a large period of time, if you can consistently allocate
Yes.
funds, then unless you make very bad mistakes in terms
Yes.
of where you allocate them,
Yes.
you will do well.
Absolutely. And that's a mindset that I had, right? As you said, that I started off with savings, moved to investment at some point in time, but the mindset never changed.
Right.
And the mindset of putting a certain amount, based on how much I've made at that point in time, was always there. That is what I wanted to do. You call it savings, you move to investments, but
Correct.
putting some money across, for all of these things was always the mindset that I had.
Right. So walk us through this a little bit. Now, we're talking about a 20-year kind of horizon here, 20-year period. Your first few years, you did your savings
Yes.
bit. When did that start changing towards investment?
So to be honest, I did savings for almost 10 years, 10
10
or
of those
11
years.
years. And primarily because I was in the US for about 7 or 8 years or even more.
Correct.
And I think the whole idea in the US was, is to just probably send money back home, put it in an FD, and I think that's how it went. Or then the money just stayed in my US accounts, right?
Because you don't know where you're going to be or what you're going to do.
Right? So it was only once I came back to India is when I truly started investing. It was all savings until then. And then when I came back with a chunk of money from the US because I had made a lot of money. Yeah. So I had a corpus to start off with. And then that's when I sort of dived into the world of mutual funds. I got in touch with a trusted wealth manager. Absolutely. As I said, I think that was the whole idea, who I could sort of trust completely. So that's how that journey has been. But over the period, I did invest with that, company or that wealth manager. But I think I just felt like I was not getting what I wanted, right? I was looking from a long-term horizon. I wanted a long-term horizon, but it wasn't aggressive enough for me. I don't think there was an aggressive thought put in. It was like, the top 5 blue chip funds that was sort of the strategy that company had, which got me basic sort of returns, but it wasn't enough for me. And that's when I decided to sort of switch and, and I got in touch with you to sort of start investing.
Right. And I remember having this conversation when we started, Sheetal, and it's interesting that we're talking 5 years, into the process. But if you rewind back to before we started, when we were just discussing,
Yes.
I remember you saying that, look, I want something that works for me, not just something that works.
Yes.
That was
yes.
one.
Yes.
The second was, I think you called it a slightly more aggressive folio, but I think what you meant was a folio that works for your long-term growth perspective.
Yes.
Because you also mentioned multiple times that you're not a very big risk taker in terms of investments.
Yes.
Right? So you want a balanced approach. So growth-oriented, but some risk.
So though I'm saying aggressive, it just meant, as you said, tailor-made for me, I just didn't want to feel like I was one of the 50 clients that they were catering to, So all of us had the same funds allocated to us, So irrespective of what sort of profile or requirements, whatever that I had, right? So I just felt I was just, there was just one strategy given to everybody. It wasn't sort of tailor-made for my needs. That's where I thought it just didn't work for me.
But why do you think that was the case? Because they knew you. You had certain requirements. I'm sure you shared it.
Yes.
And then what happened?
I think that effort to build a relationship with your client was not done, because I think especially during the initial period, you need to understand, speak, maybe research, get more details. I think that effort wasn't put in, right? It was just like, okay, you've got this corpus, you want to invest from you're looking to invest from a long-term perspective. Okay, let's do this, right? I don't think an effort was put in to really understand my needs.
Interesting. And so this is important, I think, for all of us, especially for people who are slightly earlier in their investment journeys and are starting out, or done a few years, but they have 20 years to go. Very generic or boilerplate stuff often doesn't work. Right?
Yeah.
So long-term hai, so I hear this all the time. Long-term hai, to invest in, the top 5 funds, and then you can forget about it. And there's a big difference between long-term investing and ignoring your portfolio.
Yes.
Right?
Yes.
Although your horizon is long-term, it needs to be monitored effectively short-term as well.
Absolutely.
It doesn't mean that I don't look at anything for the next 5 years just because I have 5 years to invest, right? So there's a difference between that. So perhaps one of the things you're mentioning is that.
Absolutely. That's what it is.
The other thing which is very, very important is people often slot this into, hey, this is Sheetal, she's 30, she's got 20 years, wants to grow, here are the 5 funds.
Correct.
And it just doesn't work in that boilerplate kind of a way. I think it needs to be...
and I think that's what I felt, right? I just felt like I was, 5 or 6 things out of my profile was looked at, and then investments were recommended for me,
become a bunch of numbers, and that doesn't work.
And then things didn't move, right? I didn't see what I wanted to see when I looked at how the investments were doing, right? And then year on year, it was like, you've got a long-term vision, things will move. Nothing was changed on my investments for 3 or 4 years, right? It was like, I felt really there's, you don't really need to move anything around, add new things. Are those funds like doing exceptionally well? I don't know what's happening, So I think I just didn't have clarity of what was happening. Why were things not being changed, or was my portfolio just being ignored? So I just, I think a mix of things, which I was not very happy with.
And that often happens as well. Once you invest, you normally don't see the same kind of an interest in your folio before you kind of ask a question.
Exactly.
And then you have some sort of a reactive response to it, saying, okay, let's change one thing. But that is in hindsight.
Correct.
And what you're really, if I get you right, what you're really looking for from an investment partner is you look at it before I want to look at it.
Exactly.
Right? And
that's how the trust would be built, right? That's how I know for a fact that you're actually, there is a review happening. You're making that additional effort, or you're having those reviews with me and telling me, look, things don't need to be changed right now. Explain it properly to me. I think that, and then thereon after that, you build that trust, and then, then that the person is involved in and looking at your folio.
Sure. One thing you also mentioned was, and this is an interesting piece, because a lot of people think, including a lot of wealth managers, think that if I give you the top 5 funds, you're going to be okay.
Yeah.
And our research shows, in fact, Ashlyn has published a really interesting article which shows that only 30% of the top 10 funds performed in the next 3 years.
Okay.
So top performers for the last 3 years have a 70% drop off
Right.
over the next 3 years. And that's been one of the basis of the discussions we've been having as well, right?
Right.
That there are industry cycles.
Yes.
We have to look at the cycle and look ahead.
Yes.
Not just look at what is done very well in the past.
Yes.
Because that's like a bit like driving in the rearview mirror
Correct.
kind of a thing.
Yes.
And you're sure to have some accident,
Yes.
Going ahead.
Yeah.
So that's an interesting point to make as well. I just wanted to kind of cite that. So what really changed, Sheetal? So you had this experience, you were not very happy with it. I remember when you had approached us, you had very clearly said that, look guys, I'm looking for a better quality of
actually service, right? And at that point in time, I thought, 11% return was fine or 10% return was fine, right? And I was okay with that, but I just didn't like the experience more than anything, right? I just didn't know what was happening with my folio. Were things going to change? I didn't, I think that whole service and the experience wasn't great, to be honest.
Okay. And coming from there, what's the...
So I think what changed really, right? So I think your approach first was like, look, don't give the whole thing. Let's start small. And I think that's how we started, right? We took a chunk of, I don't remember now whether it was my mutual funds or something else, but we just took a chunk of my folio and you said, let's start small.
Yeah,
let me look at it.
We started with 10%, I remember.
Let me just look at it and tell you what you think, what the folio is doing, what it should do. And that is an explanation that nobody had given me in the past. So I think that itself was very, I was very happy with it, right? You said that, look, you shouldn't be investing in these two. These two are fantastic. This is a good strategy. And you were just not negative about the folio. You just, sort of gave a very... a clean perspective, transparent perspective, right? So I think that's how that trust was built. And then over the period, I think we sort of moved that entire folio over to Cambridge Wealth. And I think the transparency has been fantastic. B, I think all of, just not you, but your sort of team and the advisors, they're always there to sort of respond to our questions. And, 3, you are sort of technology focused as well. You just don't, you're not like, okay, I'll give you a report at the end of the quarter, right? You are someone where you want to give us more real-time view of what's happening to our investments, right? So that's something that I had and at that point, I don't think we had an app or a product, right? But you had that vision or that perspective, which itself was encouraging, right? Because you wanted to be completely transparent to your clients. So I think these are the things which were initially to begin with, these were game changing for me.
Interesting. Lovely. So there's 3 things you've said. You've said transparency. You said the kind of support. And then early on, you mentioned that early you were okay with, you thought 10% was good. You were okay with it. And what's it been now?
So it's been absolutely amazing for me. Like, we've done great returns. We've probably done 2x of what I was doing earlier, right? And even though we've done that, you've still said, look, this is what we're looking at. Even if I've given you a 2x right now, this is the number that I can. So you've been optimistic, but you've been realistic as well, right? So I think that's again an approach which works for me. And I think over the years, the last 5 years, I think the level of trust that now I have with you all is amazing. For me, it's like, I know these guys are managing their own money. It's my money, but that's the level of trust that I have.
Well, I'm really grateful for your trust, because we don't take it for granted. And, one of the things we do is we never ask for trust. We earn trust through transparency.
Yes.
Right? So, and I think we continue doing that. But, let's dive a little bit deeper into these things, because they're very interesting. So what does transparency mean to you? Or what have you experienced so far?
So I think the kind of research that you'll do to then explain the investment strategy that you'll have, I think that entire process has been you're transparent. Because sometimes the research behind the investments is a black box for the clients.
Right.
Right? But
You're just given the 5 funds or
you're just told that, okay, no, these are the top 5 funds, for your long term, whatever. I mean, there's just some explanation given. But then why this fund? What is the research behind it? What is your strategy, etc., etc. I think that sort of transparency I didn't have. It's just the research behind it was a black box.
Okay. So that's one thing that is different.
Absolutely. So that transparency is important. And as I said, over the period when now that you have your app and all of that, right? We see near to real time sort of refreshes on our investments. That transparency I didn't have, right? I would probably ask for a report. I would get a report after a month or whatever it is, right? That this level of transparency, plus you've got sort of all of your detailed transactions, data, etc., to back that sort of brings in the additional trust, because now I can see exactly the transactions that have happened in the background on an app.
Right.
So these are the 2 examples that I can actually sort of give
that's very, very interesting. And, I think as we go ahead, it's very important for, all of us as investors to insist on that level of transparency. I always tell people that, trust should not be given.
Yes.
It should be earned, and make whoever you're working with, make them earn your trust.
Yes.
Because, I personally, I feel there is a problem if someone says, just trust me and go along with it. Because I'm sure it's based on some data and I would like to see it.
Yes.
Right? I don't want to just understand that this is what is right for me and do it. These are some of the questions we've even started asking our doctors, if you realize, right?
Absolutely.
Our parents, for example, 20 years back, the doctor was used to scribble something, used to go home with it.
Absolutely.
Now you're like, okay, but can you tell me what's happening? Why is it happening? All of that. And I would really encourage everyone to kind of ask those sort of questions on the investment side as well. Because it's as important. Your wealth and your health are 2 things that don't come back. So it's very, very important to kind of get those. The technology piece is very interesting as well, Sheetal, because you've had a combination of background between the capital markets and the technology. And yet you are excited about the technology when it applies to you.
Absolutely. Because see, this is something that I use. I've been building technology, I've been working technology, but I've been doing that for traders, for my middle office, and I don't actually use it, right? Because I'm not the consumer of that technology. But this is something which I consume. It's my own money, and I absolutely see the benefits of doing that. And I've seen very few wealth managers who think like that, right? I've not seen people apply technology so closely to the wealth management piece as such. And you've been thinking of that from day one, from the time that we spoke, right? So, and that's what really excites me.
Right. Oh, that's very welcome and very interesting. And I know we've been discussing some of those ideas over the years, and it's been very helpful.
Absolutely.
And it's very interesting to just walk this journey together as we're doing with all of our investors. So we understood the transparency bit. Let's understand, what kind of support were you looking for? And what has been your experience so far?
So I think 2 levels of support, right? One is an in-person support, like what your advisors, your operations team, and the rest of them give, right? So they were always a call away. They always were available. Whenever something that had to be done, I didn't really have to come to your office. So those basics, were always taken care of. Right. And the other part, as I keep saying, like the product itself or the technology behind it or the app itself, where I didn't have a dependency on a person, right? So I had that.
You need a report, it's there. You need information, it's there.
Right. And you set that up beautifully, right? So it's very intuitive, we can use it very easily. So I think both aspects, that's the level of support that one needs.
Well, we try our best, and I'm glad it's been good for you. I think, one principle, Sheetal, we've always had is we don't care about the amount of the quantum of money that you invest.
Yes.
We are more interested in making your investment journey good, balanced, healthy. And I think the entire team, and I'm really grateful and excited to work with such a nice team who kind of trust us with their careers. But the whole binding principle for all of us has been that it doesn't matter if it's a rupee or a crore.
Correct.
We have the ability to do the best with it.
Yes.
And we have the ability to do the best for our investors.
Yes.
And like you said, the part of that is, and we'll come to the performance bit, but an important part of that is to just enable you with whatever financial challenges or opportunities that you have in your life. And we are the kind of, cheerleaders for that is the way we look at it.
Absolutely.
Right.
It's been wonderful. I think your team, kudos to you and your team completely. And especially, I think, sometimes what happens is, right, people just take instructions from the client sometimes, right? But your team has always been, it's been a healthy sort of discussion with you or the team, right? It's never been like, I'm telling you to do something, do that, or vice versa. You will be like, no, this is best for you. It's always been a very sort of healthy discussion and open dialogue, yes.
Thank you so much. And I'm sure the team greatly appreciates your feedback as well.
Yes.
So let's come to the performance bit. Now, performance is an interesting thing, Sheetal, because it is a hindsight piece.
Yeah.
Right? You can never be sure, is this team going to deliver what they're talking about? A.
Yeah.
And B, it has many, many different metrics or aspects to it, right? There is fundamentals, there is quality, there is risk. I often say, it's your job to look at the returns, it's our job to look at the risk.
Yes.
Right?
Yes.
So there's a risk component to it which needs to be managed, and then through all of that, industry cycles, market capitalizations, through all of that get to a returns phase.
Yeah.
So can you tell us a little bit about let's look at your journey in three parts. So one is the savings part, then you started with a little bit with mutual funds, but with a little generic strategy, and then we started working together and we did some pretty niche and focused kind of pieces.
Yes.
So if you look at all these three, how did it?
So absolutely. So started off with savings. It was largely risk-free, so that's how we started. FDs, a recurring account and all of that. In those days, probably it gave more than 6%, but yeah, it was still less. It was largely risk-free, right? Then started off with mutual funds, slightly lower percentages as mentioned earlier, because it was just the top 5 funds. Didn't move much.
Say on an average 10%.
Yeah. So that is where we were. And then when I moved to your team, it was a mix of things. Like, you all did a lot of niche things. Even the PMSs that you all invested in, right? Some of those PMSs I had not even heard of, right? So I think you all have always, your research was very good, that you all always looked at niche things, which, as mentioned, we've actually done 2x, right? So of what I was getting earlier.
All right.
So it was a mix of, PMSs, slightly more aggressive funds. We moved around things a lot. When we knew if the market wasn't performing or wasn't going to perform, we sort of liquidated, moved to debt funds. So I have seen you all sort of work hard, at least on my folio, and I'm sure you're doing that for every client of yours.
Yeah, it's the same for everyone that we do.
I've just seen you and the team not stopping. You all have done things which has worked well, which have been niche. It's research backed. So I think that's been the journey. Savings to just the folio not changing, to the folio being moved around, and things being like looked at. Right. And we've done some risky things. We've just parked money in the debt.
Yeah.
So that is exactly what I was looking for. I was looking for someone who cared for my money.
Right.
In that sense.
Right. Like it would be, like they would do their own folio, perhaps.
Exactly.
So it's interesting, because we'll talk a little bit about the phases we went through, because there are 3 phases even after we started investing that we did. But we've always said this within to ourselves, and we've discussed this with you as well, Sheetal, that we are primarily a research house.
Yes.
And we like to focus on that.
Yeah.
And that's perhaps like the biggest difference between what we do and what your average wealth manager perhaps does, is we don't spend any time, practically no time, going out and kind of acquiring any clients or talking to them too much. We spend 80% of our effort in terms of what we can do with research or data or analytics, and then that we'd rather be a smaller house with good performance rather
Yes.
than a larger house with
Yes.
mediocre performance.
No, absolutely. And, whatever I have sort of my group of friends, whoever I've sort of mentioned how my journey in terms of the investments has been with Cambridge Wealth, I think they've not experienced something of that sort, as well. So it's like, and a few of them have come to you with
Right.
a set of complaints and,
Yes.
and they're very happy now, right? So I think that, again, as you mentioned, you don't really go out to get clients, but you'll have naturally got it, right? Like, people are going to talk well, if you're doing well. So
Yeah. We've let you do
Yes.
the
Yes.
piece, and we've focused on your folio, and you can
Yes.
you know how to do
Absolutely,
the
I can
rest.
vouch for you also.
That's I'm very grateful for that, and I'm glad you've had this journey. Now, there's 3 points in the journey that I wanted to kind of focus on a little bit, because I remember we did very, very drastically different things at each of those points. So one is when we started pre-COVID, we had a 2-year kind of period
Yes.
where we were working together, and I remember at that point of time. We had this discussion where we had allocated very aggressively to some small and mids,
Yes.
where everybody was shunning them because they had just had a 3-year underperformance
Yeah. I
period.
remember that. Yeah.
And I remember even us, when you were looking at their past performance, you're like,
So I was
my
like,
God,
yeah.
is this real?
Yeah.
And do you really
Yeah.
want me to put my money here?
Yeah, I remember asking that question.
So that was, one, period of performance where I feel you were actually going out on a limb and saying, let's see what these guys can do.
Yes.
Right? That was one.
Yeah.
And then that kind of took off. And then I remember the second piece was right in the midst of COVID,
Yeah.
where we practically went 80% into equity extremely aggressively.
Yeah. So as I mentioned, right, I mean, this is the first time in the last, like, not the first time, but since my investments have started, that somebody has actually, like, done things in my, folio with my money. And that's what I wanted, right? I didn't want to get an experience like I was putting my money in a fixed deposit. I mean, that's what happened when I went with the other wealth managers, right? I just felt like nothing was moving. Nothing was being really done. We were not making use of the market conditions.
Right.
So, and that has been sort of different here. And then, as you mentioned, right, we've discussed everything.
Yeah,
Whenever
sure.
you have wanted to make a change, we've had those discussions. I've had my sort of own, like, are you doing the right thing kind of a thing. But I've trusted at the background, and at the back of my mind, I've always trusted you all.
Sure.
And, you very patiently explained everything. So,
No, it's extremely important, because I always say the 4th pillar of investment performance is peace of mind.
yes.
And unless you have that pillar,
Yeah.
the other 3 don't matter.
Yeah.
Right? So if you're not going to sleep well,
Yes.
there is no point making a lot of money,
Yes.
because it's not going to work for you. But the other 3 are essentially, Sheetal, one of the pieces that, as you've experienced, we do is, is the macroeconomic cycle.
Yeah.
Right? That's like a 10-year cycle that
Yes.
we work with.
Yes.
Within that, there are industry cycles.
Yes.
For example, we were very heavily into infrastructure, early on,
Yeah.
in our journey. And then we moved towards industrials and
Yes.
manufacturing a little bit
Yes.
more. And now we're slowly going towards services consumption, and we'll probably proceed to kind of FMCG consumption in the next 24 months or so. So that's industry cycles. And then the third piece is really what are the bottoms up in terms of what are the funds that are doing well, who are
Yes.
the managers that are doing
Yes.
something different
Yes.
and in the right way, right
Yeah.
risk adjusted way,
Yes.
that will give you returns over a
Yes.
period of time. So 3 kind of pillars, and then the 4th one is you, which is your comfort, your risk
Requirements.
tolerance, your
Yeah,
requirements, your
absolutely.
peace of mind,
Absolutely.
and that's an important piece as well. So we're extremely kind of passionate and grateful for the opportunity to do stuff like this.
Yeah. And then that comes with trust, right? It's only when you said, you don't really force people to trust you. It has happened over the period. And that's the reason I'm okay with you telling me tomorrow, like, move 90% to debt. Nothing is going to happen, So I would it's been a fantastic journey for me, for sure.
Well, we're grateful for every bit of trust, and we don't take it lightly, and we don't assume it.
Yes.
Right? We'll always be
Yeah.
there with data.
Yeah.
We trust in God, and everyone else needs to come with data. Is the piece we've heard,
Yes.
right, from Narayan Murthy, and
Yes.
it's superb. Lovely. Good. So what do you think the next 5 years are going to look like for you and your investment journey? And how does it work for your goals? How's that piece going, right? Where would you like to go? And we just had a discussion
Yes.
about a 10-year, a decade, the next decade,
Yes.
what is it likely to
Yes.
bring? But how are you planning for it?
So I think for the next, so from my perspective, right, I think I'm going to definitely sort of do what I'm doing today and maybe make similar money, and for the next 10 years for sure, right? So I think I'm looking for an investment horizon for the next 10 years where I want to aggressively invest. I don't need as much liquidity, as we've discussed. So I want you all to sort of, I have these mixed feelings. So I need some liquidity. I don't need some liquidity. But clearly for the next 10 years, I don't need as much liquidity. And I haven't really taken out anything from my investment, in the last 5 years. So I can very clearly see that happening for the next 10 years. So that's what I want to do. Post that, then I want to be in a phase where I actually get the returns from my investments. And, then slowly sort of slow down and then start sort of getting the returns and use it, otherwise what's the point, right?
Yeah. So you want to peak the portfolio in say about 10 to 15 years and then kind of ensure that there is enough for the lifestyle and more.
Yes.
So that's one goal. And before that, there will be some sort of a liquidity event with the kids' education.
Yes.
All of that will happen.
So
So
my
you're
kids,
planning a
in
bit
the
for
next
that.
sort of, again, it's all going to come in around that 10-year period because my kids are 9 and 5. So it's going to be around that 10-year period where I would start needing, start off bigger chunks of money for the kids' education and everything else. So I think it's sort of rightly placed for me. I want to go aggressive for the next 10 years, then start sort of
Drawing down a
looking
bit.
and drawing it out,
Right. Or getting a little bit more balanced, conservative after that.
Get a little more.
So that you protection becomes a little bit
less
more
risky maybe,
important. Yeah. Interesting. And did you always plan for these goals? Is that how it went? Or because often it's an organic journey, right? You have some amount and you start investing.
Yeah.
And over a period of time, you have some milestones on your mind.
Yes.
I need X, Y, Y.
Yes.
So how was that process? Did it evolve over a period of time?
So it did, right? So I won't say I've been like a massive planner of investment goals, but for me, I knew that, I had certain milestones to meet, right? I had that 50-year, the 50th year of my life, that sort of a milestone where I want to slow down beyond that, right? From a work standpoint, I want to do other things in life.
Yeah.
So I have that milestone in mind. I have my kids' education and I have travel, certain goals. And then I have worked my investments, around those goals.
Right. So there's a short-term, say an emergency kind of a piece, and we've discussed always that some amount will
Needs
always
to be kept.
keep towards that.
Yes.
Then there is a medium-term travel, a kind of a piece that we are looking at. There is a long-term piece with the kids' education or the liquidity events required around that.
Yes.
And then there is a very long-term, which is towards retirement and the corpus that you're looking at. And I think what we've done is we've staggered investments around this. So the very long-term, very aggressive.
Right.
The long-term, aggressive but growth-oriented, not very aggressive.
Right.
Then the medium-term is balanced.
Right.
And we have some hybrids there, etc.
Right.
And then the short-term is fully kind of liquid at any point of time in your account tomorrow. So I think we've staggered it over the next 15 years, let's say, 1 year, 3 year, 10 year, 15 year kind of.
And I think that investment view, I remember seeing that once, you presented it once, where I actually got to see that investment view, right?
From the timeline.
The timeline as such, what is it that how would the investments mature, in the next 15 years or whatever, right? And what is it, every timeline, what is it that we would have?
Absolutely.
So,
and then the bell curve of it rises till a certain point, and then you have enough to kind of draw down as it goes.
So that's been interesting as well,
So Sheetal, one of the things that we've seen multiple times, it's happened with me, it's happened with you, it's happened with several of our investors, is that when we're looking for research insights, we normally get sales. right? So we get, madam, ye fund mein dal do, right? Instead of what should I be doing, why, when, where,
Yes.
how,
Yes.
right? What's your kind of experience around this?
Absolutely. I think, as I said, right, the transparency to the research was never there. So it was always a black box. It was always told, no, you invest in this, you trust me, this is what is right for you. And some gyan given here and there, but very generic stuff, it had nothing to do with what I was investing in or what I was looking at, right? So I think that was my experience. And I used to get frustrated because I thought those 1 hour meetings just didn't make sense because I was not getting anything out of it.
Yeah.
All he was trying to tell me in that 1 hour was, you invest in this. He's just trying to sell that fund to me without me giving me a comparison or without giving me logic around the research or the why, right? Which has drastically changed, and which is a very different experience with Cambridge Wealth, because I get all of that from you very clearly. And even if I'm dumb and I don't understand certain things, you would probably make it very simple and explain me that, right? So I'm confident on why you're suggesting me something. So that's the difference.
Yeah, no, absolutely. And you're absolutely right. And, the investor, as an investor, our job is not to know everything.
Yes.
But our job is to be able to understand what's happening to our portfolio.
Exactly.
Right? And if that cannot be explained for any reason, that in my mind is a red flag about the managers.
Right.
What is it so difficult that you cannot explain to me why we are doing what we're doing?
Correct.
And it doesn't need trust, it needs data.
Yes.
Right?
Yes.
And it needs real insights.
Yes.
So perhaps that
was
one
absolutely
of the
missing. Yes.
Right. There's one more piece, Sheetal, that we've done differently. But you tell us what's your kind of view around this. See, we've invested across a variety of asset classes, right? We've done the debt funds, we've done some hybrids, we've done equity mutual funds, we've done equity PMS, we've done commodities, we've done some international funds as well. We've also done some REITs, real estate exposure.
Yes.
Is this common in your view in terms of your peer journeys or what you've seen other investors do, or how is it?
Never. I mean, the variety of asset classes that I've seen where my money has been invested in via Cambridge Wealth, I've never seen that. As I said, only the top 5 funds, that's all that people invested my money in. And maybe a recommendation of a PMS somewhere, it happened at some point in time, but nothing more than that. And that is okay for somebody who is probably retiring, that's not okay for somebody who's a 30-year-old in the early 30s, has a long horizon, is making money, doesn't need liquidity, and is not risk averse as much, right? I mean, I am, but it's not as
balanced,
much, right?
Yeah.
It has to be balanced, which didn't, and I'm not seeing that even with my circle, right? Where it's like, okay, just, the some funds we've invested in 10 years back, nothing was done with those funds. And some of them, right?
And
They've
we
been my
haven't
friends.
heard back from the...
And they've never heard back. They're like,
Right.
no, good. This is where you should be keeping your money.
Just continue with
Just continue what's
where
happening.
you are.
Yeah.
Right. So this multi-asset class is extremely important because at different points in industry cycles, different funds perform.
Yes.
Like we just discussed, the mid and the smalls over the last 3 years.
Yes.
But now large caps and that PMS is going to work for us later. So I think that multi-asset class investing, for those who are watching this, please, very, very important for your portfolio. Ensure you have diversity of asset classes, not just a to-be list of funds which is investing in the same equities under them. Right? So that's
all of them
false
probably
diversification.
it's all of them are probably investing in the same equity.
Yeah. So you got to kind of look at under the hood, look at what is the right thing and multi-asset class. So that's the kind of second piece that I wanted to discuss. And finally, I'd love it, because often in India especially, investments in money is a taboo word, right? We don't discuss it as much.
Yeah.
So any points to consider, any advice for our fellow investors, our viewers who are on this journey with us, that you think can help them maybe not make some of the mistakes that you have, or some of the learnings that they can also benefit from?
Sure. So I think as I started young, right, I think I would just recommend that one should start young, even if it's a small amount. that, start in the beginning of your sort of career journey. It's very important to invest, even if it's little. It's just a habit, right? It may not be a big amount, but it's just a habit. So do that. Consistently sort of invest. You cannot be like, I'll invest for a year, then just stop or whatever. Consistently, whatever that you could invest consistently. I think that's another point. The third is, a lot of us don't have enough time to read or whatever, like I made that mistake, right? I didn't know enough happening in the market, though I worked in capital markets. A lot of times, it was not Indian markets, right? It was working for global banks. So I wasn't in tune with what's happening with the Indian market. So, read up a little. I think it's always important. It's very interesting. So do that. And I think fourth, find the right person, who you can trust, or the right organization. As I said, just don't trust blindly, but ensure that you ask the right questions, and then potentially, eventually, trust these people who are investing your money. So finding that right wealth manager is equally important. And, then you partner with them, you sort of build that trust, and you collaborate, partner. So, I think those are the suggestions that I would have.
For a fruitful journey. Fantastic. So I'm just going to summarize that. One is, start as early as you can. Do not procrastinate. I think that's one of the things that all of us do. I'm guilty of it as well.
Yeah.
With my own funds sometimes. Second is, consistency beats anything else in investing, right? So monthly, small amount, doesn't matter. Large amount, even better. Continue doing it through thick and thin. Just because it's dropped, don't stop. If it's gone up, don't do more. Just consistently invest. The third thing is, part of what Sheetal said is, make sure you're aware enough to have a good conversation.
Yeah.
And tailor, make sure the approach fits your goals. So there is no one size fits all here. Strategy needs to be, tailored to your goals, aligned to your goals. And that needs to work for you.
Yeah.
And I think then the fourth and the fifth piece would really be, and that's what you're saying, when you say the partner piece is one, are you well diversified? Is it a well structured portfolio?
Yeah.
Or is it a bunch of funds given to you?
Yeah.
And totally different things.
Yes.
Some aspects of a structured portfolio would be a multi-asset piece, which has participation from different sections of the economy that are firing at different points of time.
Yeah.
A balanced view between risk and reward, so not so speculative and completely risk oriented, neither totally risk averse.
Yes.
So you need a balance of the two, and then the different horizons that you have.
Yes.
The some amount today, some amount 2 years from now, some amount 5 years from now, and then the other at 10. So I think those horizons, look for allocations made towards horizon, not just a single long-term kind of chunk. So long-term, here is something. So that doesn't work.
Yeah.
So would that
absolutely
summarize?
Well summarized it for everybody.
Thank you so much. Thanks again for
Thank
joining
you.
us, Sheetal.
Thanks.
Lovely evening.